Julian, thank you very much for joining us today. How are things in Boston?
They are pretty I mean, the weather's pretty crappy, actually. I'll be honest with you, Jimmy. I think, I'd much rather be, well, I know the ski season's, but I'd much rather be in my other place, which is in Vail, Colorado. But ski season's ended, so we're in that sort of shoulder season. So I'm in Boston, looking forward to the summer, put it that way.
Well, I am in Toronto, so we're very close, and I know
Yep.
what you mean about the weather. The weather's just horrendous this time of year, but I still love the month of May. There's so much going on. You have the Warren Buffett AGM, the Kentucky Derby, you had the hockey and NBA playoffs. And so I was telling this to somebody last week on one of my interviews, and one of my viewers said, "Hey, you forgot the most important day of the month, and that is Mother's Day." So I got to give a big shout out there to
Okay.
all the
It's
mothers.
different in the UK, and I always forget it because it's different in the UK, and I never get the reminders from the media. So my mother gets really sort of stiffed on this one. And of course, let's not forget as well, we've got your Prime Minister and the US President meeting, and maybe that's the most important thing for Canadians.
Yeah, yeah, and I want to ask you about that later. But before we do that, I want to first start and talk about Warren Buffett and some of the comments he made this past weekend at the AGM. Did you watch it by chance?
I did not. I was traveling back from Europe. I was seeing clients all for the last couple of weeks.
So he expressed a lot of concerns about the tariffs, and he said
Hmm.
essentially tariffs are just economic warfare.
Hmm.
And he also expressed a lot of concern about the US dollar. And
Hmm.
he went on to say that if you have people who control the currency, the natural course of those people, or in other words, the government, is to make the currency worthless. And when he said that, I thought, man, that really resonates with what we've experienced here in the last 5 years because the money printing that has gone on in the
Insane.
last 5 years is just
Nuts.
unbelievable.
Nuts.
And you have also expressed a lot of concern about money printing and about the value of the US dollar. And
Hmm.
why don't we just start our conversation right here? What's your thesis? Why are you so concerned about the US dollar?
So look, I do want to differentiate, let's say the level of the dollar, the exchange rate, and the inherent strength of the US dollar. I think as things stand at the moment, and I think this goes for a number of fiat currencies as well. You know, the UK is not overly better when it comes to, say, the fiscal setup. There are some structural problems, right? I mean, certainly even pre-COVID, a lot of these countries were borrowing an awful lot of money, running large deficits, spending like a drunken sailor. And, COVID comes along and then they just sort of blow it out, right? And all right, fine, it seemed like it was the logical choice at the time, but now we have to deal with the hangovers. And while a number of countries have sort of reined in their spending, the US hasn't. And I think in that sense, I think some of the objectives of the Trump administration were quite laudable in trying and address the deficit with the Doge stuff and so on and so forth. The problem is it's been a bit of an abject failure. I mean, it looks like we started off talking, a sort of Austin Powers-esque $2 trillion. It went down to $1 trillion. And now, if you really look at it, they'll be lucky if they save 150 to, just under $100 billion. And in the scheme of things, those are just sort of rounding errors in the United States. They're not really addressing the underlying deficit, which is running at around 7% of GDP. The so that's a worry, right? That is a worry, and we aren't addressing that. The second thing is this desire, though, and this I think is the primary focus of the markets, this desire to push the value of the dollar down, right? As part of this redressing of this global trade relationship, which the US wants to achieve as part of strengthening manufacturing and so on and so forth. And I think that's actually, the combination of wanting to achieve a lower dollar and the use of tariffs as a threat is actually not new. It is something that President Nixon did. It was called the Nixon shock, and it's something that happened under Reagan as well. And both of those happened before you got big joint agreements on lower currencies. So one was the end of Bretton Woods when the dollar fell about 50% in value, and the other was the Plaza Accord when the dollar fell as central banks jointly intervened to push the value of the dollar down. So my view has been that that many of the objectives, when you look at them, while we could disagree over tactics, but many of the objectives of the Trump administration, this sort of ensure the stability of the US manufacturing sector, ensure that more of the share of the pie goes to Main Street as opposed to Wall Street, reduce the current account deficit, reduce the fiscal deficit. Those are all completely laudable objectives. But when it comes to the dollar is absolutely pivotal in dictating the direction of financial markets. And people don't understand it. Equity investors don't understand it. We were joking in Europe when I was seeing clients over the last couple of weeks that there must be a whole slew of equity funds who look at their dealer board with all the various phones, speed dials to go to the banks, and must be looking at this one that said, oh, Goldman Sachs foreign exchange. What's that one? Maybe we should press that one because we haven't pressed that for a decade, right? Because equity investors generally don't hedge as opposed to bond investors generally do hedge. And so I think that, whether by hook or by crook, this lower dollar, which I believe is starting a secular decline, I think the implications for investors are truly profound. And I don't think people understand them.
And so when you say you think the US dollar is going lower, that's because there's a mass exodus of investment dollars in the US that are just leaving?
But I think it's a combination of factors. Look, if you take the administration at face value, they want a lower current account deficit. They also want a lower fiscal deficit. And all other things being equal, when you look at those things, and this is an equation that most people don't understand, and it's not conjecture, this is simply mathematics. I'm not making many domestic American investors will take this as a very controversial statement, right? If the current account deficit declines, then the offsetting factor that funds that current account deficit, the capital account surplus, in other words, the money that flows into the US to fund that current account deficit, because you can't buy a Taiwanese chip from Taiwan with US dollars. You have to buy it with Taiwanese dollars. So you have to get those from somewhere, right? If that current account deficit shrinks, that capital account deficit shrinks, that capital account surplus shrinks, and that means less inflow into the US from foreigners. And a lot of that inflow has been most recently into equities, right? So if we get the current account deficit lower, the amount of foreign money flowing into US equities or to US assets in general, as I said, a lot has gone into equities, will decline, right? It's not a controversial statement. It is a statement of fact. You may end up 10 years from now with a structurally stronger US economy, a more robust manufacturing base, a stronger middle class, higher wages. But unless the US is increasing its own domestic savings to offset that foreign inflow, which will have a consequence, right? Consumption would drop if you're saving more. All other things being equal, US assets will be lower than potentially other countries. And I think this is look, there are lots of countries around the world that have very robust manufacturing sectors that have very high levels of wages, robust middle classes, but their equity markets are not the highest in the world. And so I think this is what people do not understand, that, if in the process of reducing the dollar, reducing the current account deficit, that means that the money is not going to keep flowing into the US. And given how relatively expensive the US equity market is versus the rest of the world, then you don't want to be long, to be brutally honest, Jimmy. You want to be out of the US. I think that people have got extraordinarily complacent over the last at least decade of just surfing a stronger US dollar and a outperforming US equity market. So I'm sure a lot of your Canadian clients have basically just bought US dollars or bought NVIDIA, haven't hedged the exposure, and just think, great. Well, if the dollar drops, the US dollar drops 30-40%, which is a standard sort of cycle, and they do nothing to hedge their exposure in currencies, or they keep holding that Nvidia shares, they're going to be a lot worse off. And those moves are happening rapidly.
Yeah, I would love to see a pullback like that. So I'm in Toronto and the Canadian dollar, it's at a 20-year low. So every time I go
Yeah.
to the US, I got to pay like a 40% premium. It's
Mm-hmm.
it's killing me. But
Not for
so let's
long, I
look
don't think. I think it's going down.
so let's look at the DXY, okay? It topped out in January at 110. Right now it's
Mm-hmm.
trading somewhere between 99 to 100. Where do you
Yep.
see the DXY going?
I think over the next year we probably fall towards 90, and I think ultimately we will probably end up falling back towards about 75 to 80.
That's a significant pullback.
It's a standard cycle. I mean, I just think, look, I've been doing this almost 40 years. The dollar cycles are big. They typically rise about 40-50% and they decline about 40-50%. And it's not that we're talking about the demise of the dollar as the reserve currency, Jimmy. We're just talking about a change in the exchange rate.
So let's talk about the S&P now. You said because of this, the US dollar going lower, the S&P and all the financial markets are going to go lower. And it peaked out in February at 6,100. It pulled back to this 4,900 level. It
Mm-hmm.
had a nice bounce. Right now it's trading around 56, 5,700. Where do you see the S&P going?
So we traded the bounce, but we're selling. I personally bought puts on Friday. I think we are almost certainly going back to test the lows. And I don't yet see the conditions for recession. I think they could emerge, but I don't yet have them. But in a relatively mild, even a sort of glancing recession, and a weak dollar environment, I think you're probably looking at an S&P that's probably, and this is not a deep recession, at around 4,400.
4,400. Okay. That's not too far away, really.
I mean, it's 1,200 points.
Yeah. And so this move that we've seen in the last few days, I believe I read there was 8 consecutive up days in the S&P. That's the most consecutive up days that we've seen since 2004. I was surprised to see that. And I also read some interesting research out of Vanguard. They said the retail buyer was buying voraciously, 4-1 on the buy
Mhm.
side. And they haven't seen that in, I think, 15 years in the history of the company. So you think these retail buyers and all this buying that we've seen here in the last week or 2 weeks, um, it's a bad move.
Yeah, it's a bad move. I mean, look, I just think retail has been conditioned to believe that in every single dip that you buy, since, I mean, 15 years, really you're talking post the global financial crisis. People forget that for most of that period, we were printing money. So of course you bought every single dip, right? Because you're just destroying the value of the denominator of the asset, right? So of course the asset goes up in price, right? It's got nothing to do with the fundamental valuation of the asset. It's just you're destroying the value of that denominator of that asset. In the Weimar Republic, in post-war Germany, when you had hyperinflation, stocks outperformed because the currency was worth nothing and the stock was a claim on a tangible asset, right? Piece of land, a factory, you name it, right? Doesn't mean that it's a great investment, right? Just means you're destroying the value of the currency. So sure, stocks went up. But that was, so retail investors just got used to that. And you have to ask yourself, is the Fed about to start QE again? The answer is absolutely not. I think, it's entirely possible that the Fed won't even cut rates in a timely manner because of the inflation impact they're going to get. My fear is that retail as well is going to run into trillions of dollars worth of foreigners cutting back on their holdings of US assets. For having been max long, over a decade building up those positions. And my fear is that they will start to cut them. And that's what I'm looking for. I will not really get committed to the S&P until I see blood in the street. And that means that US retail has to capitulate.
You raise an interesting point because this younger investor, they've been trained to think always buy the dip, right? And we
Yeah.
really haven't had a significant pullback, I would argue, since 2000 or the early 2000s. Because even if you look at 08, 09, that was kind of, it was very specifically focused on the housing market, right?
I
Whereas
mean, it's a pretty ugly equity market, but
it
yeah, I
was
mean,
pretty ugly,
yeah,
but in 2000 in the late 1990s, that was a massive bubble, okay?
yeah.
And I would say the bubbles we've seen, it's just not right now, everybody's focused on the AI bubble. But if you look at the last 5 years, 6 years, it's just not AI. It was the metaverse, it was NFTs, it was SPACs. I'm probably forgetting about cryptocurrencies, right? Like it was just bubble after bubble after bubble. And so when you say you expect this pullback from the current levels, let's just say use round numbers from
Hmm.
6,000 down to 4,000, that's a pullback of
I mean, look,
30%. And
maybe we don't, but here's what I think. If you're a non-US investor, then the best case scenario I see for US investors is the US equity market is stuck somewhere between, 4,800 and 5,600, 6,000, let's call it, for the next 4 to 5 years. But if you're a non-US investor, in your domestic currencies, you may lose another 30% if your domestic currency strengthen against the US dollar. And that's what I expect. I think the burden of adjustment is going to fall on foreigners because the US dollar is going to weaken. And while US domestics may feel like they're okay, their real purchasing power will be destroyed too. But we'll see whether that's the best case scenario.
best case, okay, because that's what I was going to ask you. And my point was because of this level of speculation that we've seen here in the last few years, it's very reminiscent of the early 2000s when the
Hmm.
S&P dropped 50% and the NASDAQ lost 80% over the course of
Correct.
2 years.
Correct.
Do you
Look, I
see it?
mean, people forget, that between 2002 and 2008, the dollar just had a standard cyclical decline. And the US economy was fine, right? It wasn't some sort of post-apocalyptic economy here in the US. I was living in the US at the time, right? Felt fine. I was still going out to bars. I was still dating. I was still doing all those things. It's just US assets were an appalling place to be invested. And the PE that we paid for the US equity market declined materially. Now the companies were still fantastic, right? I mean, we are talking today, courtesy of the investments that were made in the dot-com era, or at least the initial investments that were made in the dot-com kind of era with the internet. But what's important from an investment perspective is what you paid for it. So if you look at Microsoft's PE between 2002 and 2013, it dropped from 40 to 10, right? It's not that it was a bad company. It was a great company and its earnings were still growing. It's what we were willing to pay for it declined, right? As the dollar declined, as that foreign money started to go home and look for better opportunities elsewhere, what we are willing to pay for that story declined. And that's what I'm predicting. It's not that I think the AI story will be wrong. I just don't think we're going to be willing to pay these PEs for it. I don't think we're going to be willing to pay a PE of 20, 23 for the US, 22, 23 for the US. I think we're going to end up paying 15 at the lows for the broad market. Because if the dollar declines, that's historically what happens.
I want to get your views on the economy now, and we just saw a negative GDP print for
Hmm.
Q1, and a lot of that had to do with these net imports. They
Hmm.
surged 41%, largest jump since 1969. Everybody was trying to front run the tariffs. But where do you see the economy going? Do you think you mentioned earlier you're not too sure if we go into a recession or not, but we've seen some negative numbers coming out of all these automakers. Ford said they're going to take a $2 billion hit. GM said they're going to take a $4 to $5 billion hit because of the tariffs. Just outside of Toronto, we have a GM plant. They just announced they're going to lay off 750 employees. And you got to think like all the ancillary
Mhm.
businesses that kind of feed into that one auto plant. Where do you see this economy going in the coming months?
So we've been in, I think, in a somewhat fragile economy since really Q3. I mean, we started to lose employment momentum in the US in Q3. So it became increasingly hard to find a job. If you look at how long it took to find a job, that was increasing. If you looked at the number of people who could only find a part-time job but were looking for a full-time job, Jimmy, all of those numbers sorts of started to flag initial recessionary sort of indicators, and those in themselves were a little concerning. Um, the This was always the balance. The balance in the US, this is always the hard time that the Fed had. You know, how do we get inflation down, right? Because they hadn't got it down. It was still, at 30-year highs, even though it had fallen from the absolute highs. How do we, get inflation down without leaning too far on the economy that we push the unemployment momentum to the point that unemployment just starts to increase because it's a momentum play. It pretty much is only rising or falling. It rarely goes sideways for very long. So we had actually, I think, quite a sort of cautiously weak labor market. What saved us was a combination of things. We had ongoing fiscal spending from the Biden administration heading into the election. And then after the election, we had this euphoric pick up in animal spirits. Now, we had warned our clients on the day after the election that they were going to, everyone was going to be euphoric into the inauguration, and then we said there's going to be a big reality check, and it's going to be a hard-nosed reality check because we believed that Trump was not nearly as friendly to Wall Street as people presupposed because A, you were going to get tariffs, and B, that he wanted a greater share of the pie to go to Main Street and not to Wall Street and the C-suite, and in terms of higher wages and so on and so forth. So that's not nearly as bullish as people suspected. So it's one of the reasons we were short stocks going into the inauguration. And, now we're in this situation that you have this waning momentum. You still have this weak underlying employment momentum. Now, the good news is we still, Jimmy, don't have a lot of layoffs yet. However, it was interesting that one of the series I look at, which is the Challenger layoff announcements, it's a private sector survey by the Challenger Gray Group, where they canvass people on layoff announcements. And this last month, in the last couple of months, they've seen huge layoffs, but they were all government-related layoffs related to Doge cuts. This month, though, interestingly, those Doge cuts dropped to virtually nothing, right? Just 3,000. But the layoff announcement was still 105,000. And for April, that was one of the worst months that we've seen in an extended period of time. I think since '09, excluding COVID. Okay. And that meant you got over 100,000 private sector layoffs. So to me, that's the big variable. Like if we are going into a recession, it's going to come from the labor market. And at that point, what will happen is the real data will start to pick up, will start to deteriorate pretty quickly, and it'll end up, catching up to the weakness that we're seeing in some of this soft data, which is horrible.
Yeah. So would you agree with the assumption that maybe we're going to see the real pain? It's going to start showing up in Q2 when we see Q2
Yeah,
numbers?
I mean, I think possibly even Q4. It's really, I mean, we're some way into Q2 already. I mean, I think it's really going to be a Q3 story that we start to see that. And look, unless somehow there's a miraculous breakthrough in these trade deals, and I think the really only one that matters is China, and they don't look like they're overly ready to do a deal.
I'm always interested in looking at various companies that report their earnings. And,
Yep.
and last week we saw numbers out of McDonald's. Same store sales were down 3.6% in Q1, largest drop since 2020. And I always think like if people aren't spending $5 on a meal deal at McDonald's, like people must be feeling pain. Starbucks, they've also came out and their same store sales were down I believe 2.5%, fifth quarter of consecutive declines.
Hmm.
But what are your thoughts? Do you think the consumer is feeling a lot of pain, even though we're not seeing the layoffs show
I
up yet?
Yeah, I mean, look, clearly certain parts of the consumer. I mean, look, this is going to sound like a brutally arrogant thing to say, but the bottom 90%, 80, 90% don't matter. They have no discretionary spending. Every penny that comes in gets spent. So from a GDP perspective, they're utterly irrelevant. It kind of matters, how they allocate that money from an equity selection perspective, but that's it. Because if they spend all the money on rent, they spend all the money on rent and they don't eat. Doesn't matter from a GDP perspective, they just spend all the money. If they spend it all on food and they live in a cardboard box in the middle of the motorway, to use that great expression from Monty Python, right? I mean, it doesn't matter. The money just gets spent. The only people that matter from an economic perspective, and this is not my personal social view, right? Let me stress that. I'm much more aligned as a Brit to your sort of views on social justice north of the border than south of the border. The only people that matter are the people with discretionary income, and it's only really the top 10% that have the discretionary income, and they're actually in the US responsible for almost 50% of total consumption, which is kind of crazy, because when you think about it, they can't spend, they can't spend, they don't eat that many more meals or buy that many more handbags, right? But you start figuring out how much they pay just on their spending. They're paying 20 times for the same, effectively for the same things. So that, their meal costs 20 times the McDonald's meal. So they're fine. They feel fine at the moment. You can see it. They're the ones buying the dip, to your point, right? It's high net worth that are buying the dip, retail. And they're fine. I think what will change that dynamic for them is a sustained decline in the US equity market. That'll be it.
And you raised an interesting point there. You said 10% of the population is responsible for 50% of consumption.
48, 50, yeah.
Wow, big number.
Yep.
Okay, so you're negative on the S&P. What about bonds now? We've seen lots of volatility here in the bond market in the
Hmm.
recent weeks. Right now, the 10 years hovering around the 430, 435 level. Where do you see the bond going?
I'm getting a little concerned that we have a buyer's strike going on at the long end of the bond market. Um, that's why we're positioned in what's technically referred to as steepening trades, where we're looking for the shape of the bond curve to change, so higher rates at the long end relative to the front end. Um, I I think there's an awful lot of foreign money. I mean, I think what the US has essentially unleashed onto the world, and the way that they've done it has, particularly with China, it's a very, very dangerous game that we are playing with China. They are the world's largest saver by far. Almost 30% of total global savings are Chinese. And we need that money in the US to fund our conspicuous consumption, right? Our profligate spending, right? 7% GDP deficit, right? Fiscal deficit. By ostracizing that buyer and, let alone what's happening to currencies, right? This is a big risk. We have told Europe that we are no longer providing military cover to Europe, right? Well, Europe has been the largest investor in the United States, certainly since the explosion of the current account deficit in 2020. And why should they keep their money in the US? I mean, the whole purpose of a sort of PAC system, Pax Americana, we provide you the defense, you help fund it by recycling your savings into US assets so that we can afford to pay for that defense. That's breaking down. And I think you can see a number of very, very worrying signs in the US bond market. I mean, I don't know how many of your listeners would know, and it's not the best of of markets. It is a little bit, esoteric. But if I said to you that sovereign credit default swaps in the US, so sort of like basically a premium bet you pay to cover your exposure to the United States, is now trading at almost 3 times the UK. So, and it's above where the UK went during that Liz Truss moment, where the bond market just freaked out that the UK was spending too much money, and is now 1 basis point within to Greece, one of the European pigs from 2012, 2013. 1 basis point. I mean, that's crazy. Double Canada.
And just so I understand you, Julian, are you suggesting that investors, they're going to demand a much higher rate of return for their
I
bonds?
think this is the risk. Look, I believe that we are in a structural bond bear market. In other words, higher yields for the next 20 years, which is a function of just global demographics. It's nothing to do with whatever, anything else. It's just a function of global demographics. As we all start to age out, Jimmy, and all of those, assets that your listeners have accumulated, and then they start to spend them as they go and fund their lifestyle, right? Then that demand for those assets decline. You get more selling versus buying, and in the case of bonds go down and yields go up. Okay, and I think we're in that sort of structural environment, and that's a very dangerous environment for you to be trying to borrow and spend as much money as the United States is doing at present. Now, that's why I think what the Trump administration tried to do with Doge is very laudable. Like, we cannot afford to keep spending this much money. It's absolutely insane, right? If you want to call exceptional spending like a drunken sailor, then boy, oh boy, we are exceptional, right? But that's very, very dangerous in an environment of structurally higher bond yields, in addition to the fact that you have basically picked an economic war with the world's largest saver, right? It's a very dangerous game that you're playing here.
So where do you see the 10-year going, or where do you see the 30-year
So look,
going?
I think if we go into a deepest recession, don't get me wrong, I think the 10 years will probably rally. I wouldn't expect to see it decline more than to about 3% at best. I'm not sure the 30-year yield is going to go down at all. I think we could just end up with a really nasty outlook because the deficit will increase in a recession. Absent a recession, if we, and the only way that probably happens is if we just keep spending money and we try, for example, we get to August and it turns out that, the president manages to push through an unfunded tax bill, right? Then I think, we will be pushing 5.5, 10-year yields.
It's a big move.
These are big amounts of money. This is, I think, if I can leave your sort of viewers with anything, it's look, I've been doing this 40 years. That doesn't mean I've been doing it that long in the scheme of things, right? We've had freely floating exchange rates since the 70s. But we have big cycles, right? And there are times when you look back at your career, and I was on with a very large Canadian real money fund a few weeks ago, and I was looking at the room, and most of the room were these young professionals, right? They were in their early 30s, which meant they probably only have, less than 10 years worth of market experience. And if that's your frame of reference, and you've only ever seen the US dollar strengthen, you've only ever seen the US equity market go up, you've only ever seen central banks print money, right? You've only ever seen really, with the exception of COVID, which you think was an anomaly, you've only ever seen inflation basically fall, right? And you've only ever seen bond yields decline. That's not history. And as I said to them, if I can leave them with one thought, it was, that this is an event in history where you are going to look back 30 years from now at the end of your career, and you're going to say, wow, right? Wow. This is not one of those instances where you get the two standard deviation move and you back up the truck and buy the underlying asset because maybe we can get a 4 standard deviation move or a 5 standard deviation move or a 6 standard deviation move. Right? This is a beginning of a new secular environment. It doesn't mean that it's necessarily bad. As I said, we could come out of this, the US, with a structurally much more robust economy, a better deficit. But US assets may have just underperformed, right? Particularly in foreign currencies, right? So as a Canadian, if you've got, I don't think the Maple 8 have got something like 40% of their assets invested in the US, right? If you think these moves in the Taiwanese dollar are big, just wait till the Canadian pension funds have to start thinking about hedging up their exposure because it's even bigger as a percentage of GDP than Taiwan's, right? If dollar Canada goes down to 120 and you haven't hedged your Nvidia or you haven't sold it, you just got tarred and feathered. Right? So you have to start thinking about these things, and these things are not unusual, right? This would only be the fourth big dollar cycle that we've had since the 1970s. Doesn't mean the end of the world. Doesn't mean the US is going to become some post-apocalyptic sort of wasteland, right? These are just macro cycles that you end up with.
And Julian, how long do these cycles typically last for?
About 10 years.
So just because we're talking about yields, we might as well talk about interest rates and the Fed. And I love the back and forth that's going on between the president and Jerome Powell. And I love how the president calls him too late. What are they? Too late, Jerome Powell? I
Yeah,
think
something like that. Yeah, yeah.
But where do you see interest rates going this year? What do you think the Fed
Look, I
does?
think the Fed is in an extraordinarily difficult situation. I think they're playing their cards correctly. They didn't cause the problem, right? They didn't spill the milk, so why should they be the ones to mop it up? I think they've learned their lesson as well from last autumn, where they cut rates and the long end of the bond market sold off. Right? That's really dangerous. You don't want that to happen, Jimmy. That's a very bad sign. Particularly at these sorts of levels, right? And so I think they are going to wait till we see clear signs that the labor market is weakening before they move. And when they do see those, they will move aggressively. I hate to tell you, historically, at that point, it's already too late because employment is a lagging indicator, and that momentum will continue to wane. And so I do think they, as I said, I don't yet have all the conditions in place for labor market weakness. I think they're coming. I would put the odds at, slightly over 50% at this point. Right? I need a few more things to slot into place. But yeah, I mean, I think when they will go aggressively, but it will be typically too late. And so I could see them cutting rates eventually to the low of this cycle to around 2%. Right, but I think you'll end up with a pretty steep bond curve. So they might go to 2, 10-year yields might be at 3, 3.5, 30-year yields maybe 4. 4.5.
Yeah, I'm surprised how this unemployment rate is continuing to hang in around the 4.1, 4.2 level. I mean, it is up off its lows,
Yeah,
but it
not
still
much.
seems
Because no
contained.
layoffs yet, Jimmy, right? I mean, I think what we've seen is we've seen hiring, as I said, the rate of hiring has slowed dramatically, right? Firms are just sort of sitting on the employees that they have, hoping to see how this whole thing settles down. But the longer this drags out, the less certainty that we have, the greater the risk. I mean, look, let's be brutally honest. There is only one job of a CEO these days, right? Of a publicly listed company's CEO. It is not to produce a good, right? It is not to produce a service. It was, up until very recently, not to produce a profit. It is simply to drive their stock price higher. It's the only job they have. It's literally the only job they have. That's how they get paid. They're the most leveraged members of the equity stack because they have options, so they get paid. And that's all that matters. So when stocks are rising, CEOs hire, and when they are falling, CEOs fire. And you can literally go and look at a chart of the US equity market against total employment in the US, and the equity market leads by 6 months.
Julian, when we started this conversation, you made mention of the fact that Prime Minister Carney is in Washington meeting with the president. What do you think the outcome is going to be?
I don't know. I mean, it's a really interesting dynamic. I mean, I think we can all hope that it's some sort of rapprochement, and they come out as, bosom buddies. I'm not sure that that's going to be easy. I think, Mark Carney, I think has enunciated, I think, a thought process that's going on a lot around the world, that the relationship between various countries or between many countries in the US now has fundamentally changed. And the idea that we can put Humpty Dumpty back together again is unfortunately, I think, not the case, right? I think, we're going to see whether you guys are going to buy F-35 fighters or whether you're going to buy, the Swedish equivalent. I think that's going to be an interesting litmus test to see how things are going. Maybe they can, make a deal, right? I'm not sure. A lot of the things that I keep hearing around these tariffs are quite difficult. Like, countries are trying to come forward and put their best foot forward and offer something that they think is reasonable to reduce tariffs, to get rid of, I don't know, import more dairy or whatever the heck it is that you need to do in Canada. The problem is the sort of baseline of the US is you get rid of all your tariffs and all your non-tariff barriers and your sales tax and your, whatever else we decide that we don't like this week. But our baseline is we're going to charge 10% tariffs and some sectoral tariffs on, whatever heck, certain key industries. And that's just not really the fair basis of negotiation. So I think it's going to be quite difficult to get fundamental deals.
Do you have any views on the Canadian economy?
I think, you're going to go through a rough patch, obviously, right? You're very, very dependent, but your good news is fiscally, you're in a pretty solid space, right? You're not the UK or the US in terms you haven't gone, hog wild over the last few years spending money. So, you can possibly pivot. It will take time. It will not be costless. But I'm sure the Europeans would love you to buy houses there and not in Florida.
Well, speaking of the real estate market in Toronto, where I reside, sales plunged 23% year over year. Listings are up 54% in the past year. So we're feeling pain here. And you got to realize our economy, it's been in, I would say, not dire straits, but it's been hurting for quite a few quarters now.
Yeah.
And in the 10 years that the Liberals ruled, our GDP grew from 1.8 trillion to 2.1 trillion.
Right.
If you can believe that.
Right.
In the province of Ontario, where I reside, unemployment rate is 7.5%.
Right.
That's a 10-year high.
But you're not spending 7% of GDP. The government isn't spending 7% of GDP. I mean,
that's right.
If you were, I'd suspect things would look better.
Yeah, right? And maybe they're going to have to do that. Maybe they're going to spend, 10 or 20 possibly. Or $30 billion on a pipeline, or I don't know, whatever, infrastructure. Right?
Yep, absolutely. I mean, I think, look, I hope this thing can all settle down. I think, as I said, I don't believe, I hope all this works. I just believe that we are at a historical point in market and in history. And I think one has to approach investments with that sort of perspective, that this is not necessarily going to look like the last, 5 years or 10 years even. This could look radically different. It doesn't mean the end of the world. It just means that you need to think about, as a non-dollar investor, you need to think very, very, very carefully about your dollar exposure, whether direct or indirect, because you own a bunch of US assets.
And so that's a good summary right there. And so this movement that we've seen in the last few months where stocks, bonds, the USD are all under pressure, you think that's going to continue? You
No,
think
I
the
mean, I
S&P,
think that's in itself that really like intense period where you're pummeling all of those assets. That can't go. I've seen that. I've been doing this like 40 years. I've probably seen that half a dozen times, and we used to refer to it when I was at one of the when I was running a foreign exchange sales desk many years ago as what we would call a sell the US moment. But it was a moment because, Jimmy, it would never last more than about an hour before policymakers would have to come in and respond, right? Because basically you're pulling the plug on US assets and you can't have that, right? Something needs to, and we saw, right? Scott Bessent and the team came in and sort of, oh, okay, yeah, we're going to contain this. Um, so that sort of intense selling, I don't think will continue, but an underperformance, sure, right?
and this level right now in the S&P 5600, 5700, you think that's an opportunity to sell? It's going to continue to go lower. I think you said your level is 4400 on the
Well, I
S&P.
think, look, no, I mean, look, I think we're selling here. I think we go back and test the lows. If at that point we end up with a recession, then a different, that's a different setup. But we need to go back and test the lows, see if we can hold those lows. What I think for, listeners in Canada is I think you really need to watch your Canadian dollar very closely because to me, this is beginning to look quite intriguing. If you start to close much lower than this in dollar CAD, I think you're taking out, multi-year trend lines of support in the Canadian dollar. I think Canadian pension funds are woefully unhedged in a not overly liquid market. And I suspect when you get, the big Canadian pension funds trying to call up Bank of Montreal and say, where can we hedge, $20 billion, right? The answer is going to be not cheaply, right?
So I want to quantify that the Canadian dollar went as low as 145 against the USD. Right now it's around, I think, 138. Where do you see
Yep.
it going?
I think we're probably going back to, and it might take some time, but I think we're going back. The next real target for me are sort of the low 130s. And then if we can break through that, I think it's possible we move down to sort of that 125 range.
Okay. So there is some sunlight. Well, Julian, this has been a great discussion. I want to thank you very much for spending time with us today. If somebody would like to learn more about you and your firm, MI2 Partners, where can they go?
So we have an institutional product. So if you're an institutional investor, you can reach out to us. And if you are a retail investor and you're interested in knowing what we offer on that side, which we do, actionable stuff, you can reach out the same place, support@mi2partners.com. And if you just want to follow me on Twitter, or X, I guess we have to call it these days, you can reach out at Julian MI2, and it's Julian with an A, not the E like the French.
And I will have a link below in the show notes. Julian, once again, thank you.
Cheers, Jimmy.